Okay guys, it's Darren from Honest Money, and in this video I'm going to show you how to pay yourself as a director of a limited company in 2020 and 2021. Now before I get into this video, I just want to say that I am not an accountant. However, I do have over 10 years experience running limited companies, so hopefully the advice I give you in this video is accurate. However, whatever salary you decide on, I would recommend checking with your accountant. So before I get to the director's salary itself, I want to just quickly run through some of the key areas that you need to be aware of when looking at your director's salary. So the first thing I want to take a look at is your corporation tax. I then want to take a look at income tax, followed by national insurance, and then the dividends themselves. And once we've got a background on all of those, when I then give you the director's salary, it should make a lot more sense. And then at the end of the video, I'm going to do a comparison between paying yourself with the method I recommend versus paying yourself the more traditional PAYE route. So on to the first thing, and that is corporation tax. Now, corporation tax is quite straightforward. It is payable against net profits made by a limited company. So what do I mean by net profits? Well, if you make £50,000 profit, and then you spend, say, £20,000 on salary and overheads, then your net profits are £30,000. So your net profits are whatever is left after all overheads and expenses are taken into account. Now, the old rate for 2019-2020 was 19%, and this year it was supposed to come down to 17%. However, the government stopped that change, so the rate for 2020-2021 will stay at 19%. Now, it's worth remembering with your corporation tax that allowable business expenses can be used to reduce your corporation tax liability. So some of the very common expenses that most limited companies will have include salaries, which I'm going to get to in a moment in more detail. We then have home office use. For example, my studio is my home office, and I can put that through either £4 a week or £18 per month, and HMRC will not question that. So that's money you can pull out of the business. That's over £200 you can pull out of the business completely tax-free as home office usage. Each director is allowed one mobile phone, so your contract costs you can put through the business as an allowable expense. You also have fuel, which is a very good way of getting money out of the business. All you need to do is keep a log of all of the business mileage you do, and then you can claim 45p tax-free for any of those miles up to the first 10,000 miles. Then after that is 25p. So there's quite a big allowance there for being able to come up with a mileage log, which is of course fully genuine, that you can use to then pull money out of the business tax-free. And then you also have finally accountancy fees. Now there are lots of other business expenses to look at, and always make sure you check with your accountant whether something you was going to buy is going to be passable as a business expense. The next thing that I want to look at is income tax. And again, like corporation tax, this is quite straightforward. So income tax is paid on your income, excluding any dividends, which I'm going to get to in a moment. Now, the personal allowance for 2020 and 2021 is £12,500. So everyone can earn £12,500 without paying any personal income tax on that money. There are three income tax thresholds that you need to be aware of. You have the basic rate, which is from £12,500 to £50,000, which is taxed at 20%. You have the higher rate, which is from £50,000 to £150,000, and that's taxed at 40%. Then you have the top rate, which is £150,000 plus, and that's taxed at 45%. So that's the income tax covered, and you also have national insurance to consider as well. Now, national insurance is a little bit more complicated, and there are three thresholds to be aware of. So the initial threshold to be aware of is called the lower earnings limit, also called the LEL limit, and for the purposes of this video I'm going to call it the benefits threshold, because this is the threshold where once you pass that in terms of how much money you earn, that is when you qualify for state benefits such as your pension. So it's super important to make sure you're paying yourself above this limit every single year. So the thresholds for this year are £120 per week, which is £520 per month, or £6,240 per year. So as long as you're earning over that via your PAYE salary, then you'll qualify for your state pension tokens. The next threshold to be aware of is your primary threshold. Now this is your personal threshold or your employee's NI threshold. So this is the point in which yourself as an employee, you will become liable for paying national insurance. Because remember, there's two types of national insurance. There's national insurance paid by the employee, and there's national insurance paid by the employer. So the national insurance primary threshold refers to the employee, and the thresholds for this are a bit higher. So you can earn up to £9,500 per year before you pay any national insurance. So you notice that these don't marry up with the income tax. So you can earn £12,500 without paying any income tax, but you'll start paying national insurance above £9,500. Now with personal national insurance, there are two different levels. You pay 12% anywhere from £9,500 to £50,000. Then anything above £50,000, you only pay 2% national insurance on. Now the threshold that you really need to be aware of from a limited company perspective, and that is the secondary threshold. Now last year and in previous years, the secondary and the primary thresholds have pretty much been the same, if not identical. So usually they're kind of interchangeable. However, this year there is quite a difference between the two. So the one you need to focus on is the secondary threshold, because this is when the employer becomes eligible for national insurance as well. So the thresholds that you need to be aware of with this are the monthly and the annual threshold. So just be aware that you can pay yourself £732 per month without incurring any employees or employers' national insurance liability. And the other thing to remember as well is with this secondary threshold is that employers pay national insurance at 13.8% above the secondary threshold. So any earnings above that limit, so anything above £8,788 per year, the employer, i.e. your company, will be paying national insurance at 13.8%, and there is no higher limit of £50,000. It doesn't drop down to 2%. It stays at 13.8% for however much you pay yourself above that threshold. Now finally, before we get to the salary itself, we have dividends. Now dividends are payable from profits or retained profits from the previous year. So that is from your net profits. It can't be before expenses. This is after expenses. So dividends are payable from your net profits for your current year or retained profits from previous years. It's important to remember that they are only payable to shareholders and that we all have a £2,000 tax-free dividend allowance per year. In addition to this, we can also use up the remainder of any personal income tax allowance that we haven't used as tax-free dividends. So for example, if you've only paid yourself a PAYE salary of £8,000, because you've then still got £4,500 of unused income tax allowance there, you can take that as tax-free dividends. So although you only get £2,000 of tax-free dividends allowance, if you've got unused personal income tax allowance, you can combine them to take you all the way up to the £14,500 threshold, which is £12,500 of income tax allowance and also £2,000 of dividend allowance. Now dividends effectively used to be tax-free. However, a few years ago they changed the rules, and anything above that £2,000 allowance you will pay a 7.5% dividend tax on. Now that applies all the way up to £50,000. Then anything between £50,000 and £150,000 you'll pay 32.5%, and then above that it's 38.1%. So there are different dividend tax thresholds to be aware of, but for the purposes of this video and in the example I'm going to show you shortly, we're just going to look at the basic rate, which is the 7.5% basic rate threshold. Now just before I share with you my recommended director salary for 2020-2021, if you're finding this video useful, I'd really appreciate if you could take a moment just to hit that like button. It makes a big difference to the channel. Also, if you aren't already, please feel free to subscribe as well and hit that notification bell to receive alerts when future videos are released. So this is the bit that you've all come for, and this is my recommended director salary for 2020-2021. Now, as mentioned previously, in 2020-21, you can earn £14,500 tax-free, with £12,500 coming from your personal allowance and £2,000 coming from your dividend allowance. However, I do not recommend paying yourself £12,500 as your basic salary due to the double taxation issue of employers and employees' national insurance. Instead, what I would recommend is paying yourself a salary just under the national insurance secondary threshold and then topping that up with dividends. So this example is based on paying yourself £40,000 per year as a sole director of your own limited company with no employment or income coming from elsewhere. So with that in mind, my recommended salary is £8,784 per year, which breaks down to £732 per month. Now this is just under the £8,788 national insurance secondary threshold, but it's above the LEL, which is the lower earnings limit, to ensure that you qualify for your state pension and other state benefits. Now, by using this salary, you won't be liable for any income tax, employers' national insurance, or employees' national insurance. You will, however, be liable for some dividend tax. Now, initially, you have the rest of your tax-free allowance, so from $8,784 to $14,500, you will pay zero dividend tax. However, above that, between $14,500 and £40,000, you will pay dividend tax at 7.5%. So it's not a huge amount, and it's a very tax efficient way of paying yourself. So your total tax on that is £1,912.50. Now, for those of you that are wondering how paying yourself a basic salary plus dividends compares to paying yourself fully via PAYE, this is what I'm going to compare on this slide. So the first thing that I want to go through is the salary from the previous page, but this time taking into account corporation tax, which I'm going to come back to in a moment. So based on a £40,000 salary, you're going to pay yourself a base salary of £8,784. Remember, that's tax-free and there's no national insurance due on that either. You also then have the remainder of your personal allowance plus your £2,000 dividend allowance, bringing up your total to £14,500, which leaves £25,500 subject to dividend tax. As you can see there, from £14,500 to £40,000 is subject to dividend tax at 7.5%, which comes to £1,912.50, which is the figure I gave you on the previous slide. Now remember, there's no income tax on this, and there's no employers or employees national insurance due on this salary. However, with this method, you are liable to pay corporation tax. Remember, dividends can only be drawn down from net profits. So based on paying yourself £40,000 and taking off the £8,784 allowable PAYE salary that you're paying yourself, that leaves you with £31,216 subject to corporation tax, which gives you a corporation tax bill of just under £6,000. So with all of that in mind, from a £40,000 salary, you would have a take home of just over £32,000. So how does paying the same salary fully via PAYE compare to that? Well, the first thing to consider is that as you're paying that full £40,000 via PAYE, there is no corporation tax liability, as that £40,000 is a legit expense. So there's no corporation tax to pay on that salary. The next thing to consider is that you will be using your full personal tax allowance. So you'll get that full £12,500. Now we're not using dividends with this example, so your tax allowance is £12,500. So with that in mind, that will leave a total of £27,500 that is liable to income tax. Now at a 20% threshold, that is a total of £5,500. On top of that, it is also going to be subject to employees' national insurance. So from the primary threshold, which is £9,500 to £40,000, you'll be paying 12% employees national insurance, which is £3,660. So when you take off the income tax and the employees national insurance, you'll have a take home of £30,840, which is about £1,300 less than the take home was on the basic salary plus dividends options. However, that's not the full story, because remember, the employer themselves is also subject to national insurance. So they're going to be paying national insurance from the secondary threshold, which was £8,788 to £40,000, which is £4,307. And when you combine those together, you would actually be £5,600 worse off if you pay yourself fully via PAYE instead of paying yourself a basic salary and then dividends on top. So I hope you guys found that really helpful. I know I went through quite a lot there and I went through it quite quickly, so please feel free to rewatch this video as many times as you need to. Now, if you haven't already hit that like button, please do. And if you haven't subscribed, please subscribe to the channel, and I'll see you guys in the next video.